This is something special. Algorithms over opinions. So this itself says that it is quite interesting. So to do that, I would like to invite Bhautik Ambani. Bhautik Ambani, please. In this business, we often say that the market is moody, but do you know why it's moody? It's just because of the logics. The most investors fail because they follow opinions that change every new cycles. Our next guest, the Bhautik Ambani. So we'll give you the insights on how it exactly works on, and the man who trusts the code over the noise. Over to you, sir.
Thank you.
Give him a round of applause.
I hope I'm audible. Thank you. Thank you everyone for having me here. Thank you Alpha, thank you Srikanth for arranging this amazing event. I can see people have traveled from across the state, across multiple states in South out here, which is phenomenal. Talk about today, I also saw happening at the buffet here. I was just talking with Alpha where discipline, right? So I don't think this will work anywhere else where discipline works, where you have to give a coupon to get your plate. So, this is again process, discipline, but actually works. So I think it was very relevant. So what I'm going to talk about today is not some, lecture around AI or technology or algorithms, but broadly around the fact that the world is changing, okay? And I think even today itself, I think you guys have heard another session which talks about AI and, how it's changing the world and how it's kind of relevant for all of us in some sense. So, so in some sense, I'm going to talk about what is changing, why is it relevant for us and what we need to do, rather than just talk about, where things are, but kind of try to put in action in some sense. Let's look at some of the headlines over the last, so these are headlines over the last 1 week. Okay, these are not headlines over the last 6 months, 1 year, 10 years. These are headlines talking about 5 different things and in the last 7 days. So that is how quickly the world is moving or changing, okay? So if I were to just look at a couple of them, so there was a headline which talks about a new AI tool which has come in the US just a couple of days back. And on that same single day when that tool got introduced, wealth management stocks in US and large companies which have been operating in this space for many years or many decades were down 8 to 10% in a single day with just one AI tool getting launched. A similar thing happened when Perplexity launched another tool, and that is potentially going to impact multiple industries, including logistics, including law firms. Then there was another AI tool that got launched again a couple of days back, which pretty much impacted all real estate companies or property service related companies in UK and US. The point that I'm very simply trying to make, and in fact, a lot of this we've seen in our markets also, right? What is happening to our own IT stocks in the last month or so? We've seen the IT index correct almost 18 to 20%. And these are companies which have been operating in this business for more than 30 years. Can you all imagine there is one AI company which has come into existence maybe 5 years back. Today, the market cap of that one company is more than the cumulative market cap of all our IT companies. That's Anthropic. One company which has come 5 years back and which is more than the market cap of all the companies cumulative together which have been in existence for like multiple decades. And that's how quickly the world is changing. So few years back, if you think about it globally, an IT company needed tons of people to go and sell. They needed many people to go and make demos. You needed a separate implementation team, and then you had a whole customer service team. Today, the entire value chain is automated. You don't need these many people. Why only talk about the world, right? Let's talk about what happened in our own broking industry maybe 10 years back. Till 10 years back, if you think about our own broking industry, you had brokers having branches, branching is having RMs. RMs used to call clients, give ideas, tips, whatever you may talk about, right? You had tons of paperwork. Then you had a couple of fintech platforms that came in, okay, like Grow, Zerodha. What did they realize? They only understood and realized one thing, that investor behavior is changing. And what did they do around it? They built technology around it. It's not that they give better stock tips or stock ideas compared to any of these existing guys. That's not the case. They only built, the most important thing is, more than technologies, they understood that behavior is changing and what is going to change in the future and how do I adapt to that. And today what happened? Because of which they are today having millions of customers. It's not that the existing guys became obsolete. That doesn't happen in any industry. But what happened was that a lot of these existing guys, their growth rates slowed down, their margins shrunk. And people who did not adapt have also gone out of business. Now let's kind of try to bring this closer to all of us, which is the mutual fund industry. Okay. This is just data that I picked up from Amphi last month end to 5 years back. Exactly 5 years back. So I've taken equity-oriented schemes, hybrids, which is pretty much the two large active categories that we have. And then I've taken the passive category, which is index funds, gold ETFs, and other ETFs. I think all these numbers are not relevant. What is relevant is here. Active fund AUM in this period has gone up by almost 3x. We've seen a phenomenal explosion, right, in AUM in the last 5 years. So active funds have gone up by 3x. The number of people investing in active funds has gone up by 1.8x. But what is more important is, look at what has happened to passives, which is the last 3. AUM has gone up by 20x. And this is not institutional money, because the number of folio growth is telling you this is not institutional money, this is retail money. Now the point to ask ourselves as a question is that none of these passive products actually need intermediation. They don't need intermediation, right? Like, I don't think any one of us need to go and sell a passive product, because the investor who's looking to buy passive is actually looking for lower cost, a simpler product, and something that he can buy in a click. Now the question that we need to ask ourselves is that, is this a fad which has only happened in the last 5 years? This is more structural, which will continue in a similar trajectory. I think the answer is again with data. So if you look at the West, and in some sense, we follow the West, right, with some lag. Maybe those lags are going to shrink now with technology, but we do follow the West. So if you look at the West today, or the US today, there is more AUM in mutual funds, which is under passives or some kind of quant strategies, compared to active fund managers. So today what has happened in India, we've only seen a glimpse. This trajectory, this trend is not going to change. Now the other question to ask is, why is this happening? Have fund managers become bad? The answer is no. Have they stopped doing what they were doing in the past? Again, answer is no. Why is this happening? There are multiple articles, multiple research reports which are also talking about the fact that many of our mutual funds are not even able to beat the benchmark. And that's another reason why people are going toward passive, right? Why should I pay 2% fees when I can buy a product which is going to give me similar returns or better returns at 10 basis points? The reason this is happening is that what we need to understand is technology is taking away information arbitrage. Think about it, 10 years back or 15 years back, how did annual reports come to you? Physically, on paper, somebody had to put in the effort to read that annual report, a 100-page annual report, right? So there were some people who would put in that effort, And there were some guys who would not put in the effort, would just say that I will rely on balance sheet P&L and take my decision. But somebody who read that annual report had something written in that notes to account which would give that person an information edge. And that was the difference between those two guys to generate better returns compared to worse returns. Today, how is that annual report coming? Nobody reads the annual report also, because by the time the annual report comes, it's already analyzed and given to us as information. So today, everybody in this room has the same information at the same time. Where is the information arbitrage? The second thing that has happened is that because of technology, there is a lot more data out there. The amount of data which is out there is so goddamn phenomenal that it's very, very difficult for humans to even consume or process. And that's the other challenge that we are all facing. Now, is there an opportunity? Is there, something that we can do which keeps ourselves relevant? Is the question that we need to ask. Because if you think about it, if this is going to be the trend, and if we continue doing the same thing that we are doing today, then our relevance will only shrink. Because today, all our investors have the same information at the same time because of the hundreds of thousands of platforms that are available today which is giving out information. So which means that whatever we are doing today has to change for us to remain relevant in the future. Right? One of the things that we believe is a solution to this is where you try to marry what humans are doing with that quantitative advantage. We obviously try to coin it saying that UMAC, but in simple terms, what this is doing is you got to marry what the human mind is doing along with data or technology. And that combination is what we believe is the future. And in very simple terms, in the investing landscape, this is called quantitative investing. I have somebody very young here, who's trying to build a algorithm-based platform. Now, why is he doing that? He's doing that because he believes that algorithms matter, right? That's why you're doing it. So ultimately, what he's also trying to do is build something with data. Now, where does this combination come into play? The combination comes into play in such a way in the investing world is that you can't ignore human judgment. You can't ignore the fact that humans or any investment person has some insights on corporate governance. And that one has to marry with data, backtesting, behavioral patterns. And when you do that, what you ultimately come to is some kind of a combination where you combine the conventional style of investing, which is looking at fundamental data, and combine it with a lot of alternate data. When I say alternate data, today do you all believe what people are buying and selling as retail investors matters? Do you think that trend matters? Do you think what people are talking about on social media matters? All that is alternative data. Now, unless you know what is happening out there, how will you know what is the trend? So which means that you have to look at a platform which is combining both these worlds, which is the traditional way of investing and the new way of investing. And that is what is going to give you that answer of the future, which is, let's say, around quant investing. Now the next question to ask is, if we believe that quant investing is the future, right, which is combining the best of both worlds, where human emotions are not there, behavioral biases are not there. Can I give you an example of behavioral bias? Do you see phases when certain fund houses or certain fund managers do well and don't do well? Have we all seen that? Why does that happen? ऐसा तो नहीं हो सकता ना कि एक फेज में एक फंड मैनेजर अच्छा कर रहा है उसके बाद उसका that is because of market cycles. Because what tends to happen is that, let's look at a classic example, pre-COVID. You had this entire phase when high quality and high growth companies were doing well. So that was a cycle of quality. And any fund manager or any house which was following the philosophy of buying quality companies with growth also did well. What happened after COVID? Cycle changed. Market structure changed. So quality stopped working, and what came? Value, momentum. These are market cycles, phases which have happened in the past and which will continue happening in the future. And the way technology and data is moving, these cycles will become shorter and sharper. Which means that if we all keep looking at the rear view mirror in investing, which is the last 1, 2, 3 year returns, how will you know what is going to work in the future? So that's the reason one has to think about the fact that where do you remove this behavioral bias? Is there an approach which is not married to one style of investing and it can actually go across multiple styles of investing? And that's exactly the reason I'm standing here, is because the firm that I represent here is called Alpha-Grep. We've been doing this for the last 16 years in India and in the global markets as well for the last more than a decade. Because what is important to understand is that not just kind of accepting the fact that yes, quant is the future, but who to back on quant is also very important. Like we don't see all fund managers perform the same way in the long term, in exactly the same way, quant will also not behave or perform the same way for everybody. Because quant is a combination of two things: the people behind the model and the data. Until unless I have access to enough and more data, my models will never be robust. And until unless I have, and even if I have access to all the data, until unless I have the people who know what to do with those models, I will not have the right combination. And that's exactly what we've done over the last 16 years at Alpha-Grep. I'll just give you some background here about us. So we are a 16-year-old firm. Our DNA is only quant investing. For the last 16 years, we don't do anything but quant investing. To give you some numbers here, we run two businesses today. One where we just manage proprietary capital. Proprietary meaning our own money. And the second part of the business is where we are now managing third-party capital as well, which is what we call asset management. In the proprietary business, in the last 16 years, we've grown to a scale and size where we are amongst the top 3 prop trading firms in the country, broadly. There are no official rankings anywhere, but broadly we are there by way of capital, revenue, market share, profitability. Just to broadly put some numbers here, our market share on NSE, on derivative segment would be around 3 to 5% of daily volumes, closer to 7-8% of daily volumes of BSE on an average. We are connected to almost 30 exchanges worldwide, so we just don't trade India, we trade global markets. Now coming to the most important part is capabilities around quant, right? In our proprietary business, we have 450 employees. Now it's just not the number that matters. Those 450 people are split into 3 parts. Half of them, so broadly around 250 of them, are what we call quantitative researchers and traders. In very simple terms, we have a 250-member investment team who are spread across 25 fund management teams. So on an average, 8 to 10 people per team. So we have 25 fund management teams which are internal to us. The second thing, like I mentioned, what is very critical is data or technology. We have a separate 130-member team which only manages the technology infra for the company. And they, for the last 16 years, they have a separate data team which has only been collecting and storing data in the library. Imagine the vast amount of library of data that is available to us. The other thing is that because we've been doing this in India and global markets, what is important is that it's not that we've just built these models for India, these models work for us globally as well. Okay, so that talks about the robustness of what we've done. The last thing that I want to mention out here is that along with proprietary capital, now we also manage third-party capital. So overall, we are managing more than $1 billion already as a firm. Till now in India, what we had done was only products in the AIF, PMS, GIFT City space, which was largely targeting high net worth individuals, family office institutions. Now, very recently, we also got our in-principle license for a mutual fund business. We are hoping to get our final license soon. So once we get that, we are hoping to get our institutional infra, people, capabilities to retail. And that is what we are looking forward to launching in the next few months for sure, right? So I've been told that my time is up. So thank you so much for having me here.
Mr. Ambani, please. What a powerful points from a powerful surname person. Thank you so much. And you precisely kept it very simple, saying that how are you going to be ready today to face the future in terms of the technicals, the fundamentals, and the behavioral aspect covering as well. Thank you so much. Big round of applause. Please be here. I would like to invite Mr. Satish Rajaram and Ravi Kant to come on stage. Please keep clapping, please. Music.